All right, so we are starting with chapter 1, the purpose and usefulness of your financial statements. Now, any idea about what we will be covering in accounting? In accounting 2121?
Reading financial statements, doing accounts, debits, looking at performas, 36-month financial analysis, stuff like that.
Okay, that's a very strong start. What else? Anyone else wants to add to that?
Balance sheets.
Balance sheets, okay. What else?
We may be looking at financial statements, stuff basically related to how business runs and all of the more accounting side of it.
Perfect. That's very good, guys. Okay, so basically what we are looking at is accounting is it's a system where we are capturing all of our economic events. Okay, we are only concerned with the financial data. Anything that is not financial does not concern us as an accountant. So we represent this or reflect this data in terms of your financial statements. Now, when these financial statements are put out into the market, there are different types of users that will be using this financial statement. Right. So in terms of the users, then there are internal users and there are external users. Internal is anyone who is employed by the business. It works from an internal perspective, sees the information firsthand before it goes out. On the other hand, our external users is something that is external or outside to the company that does not see the firsthand information. So that is people like your investors, lenders, bank, CRA, or your regulatory bodies, anyone who is outside of the business organization. Okay? So from the internal user's perspective, we are looking at the company's officer, managers, directors, HR, resources, production, marketing, accountant, anyone that you can think of that's employed by the business. Now, keep in mind, depending on who is looking at that information and why they're looking at that information, they can get different types of analysis, right? So what we'll be looking at in 2121 is the reader's perspective. Who are you? What are you looking at? Why do you need to look at these financial statements? And what is it that you're trying to get out of that? Okay, so depending on who you are, you can make a reasonable assumption or determination about the company based on what you see, right? Now, again, keep in mind when we issue the financial statements, it's the same financial statement that is put forward to all of these users, right? So we have to make sure that we are abiding by the accounting rules, which is governed by the generally accepted accounting principles. So when we are representing this information to wide variety of users, okay, that's where your ethical behavior comes into play. Sometimes what happens is the companies are motivated to present the best picture about their business to their lenders, okay, because those are the biggest guys. Say, for example, for a private corporation, I work for a private corporation, and we'll talk about what that is in a bit. So I work for a private corporation, and for us, our biggest stakeholder is always the lenders, which is our banks. So it will be unethical for us to find the information that will favor them. Okay, that's unethical. So ethics is the gray area between right and wrong. How should you treat those transactions? How should the business be run? So technically speaking, every business has a code of conduct that they go by. Okay, they define how they want to run their business, what's ethical, what's not. Okay, so that's basically what an ethical behavior is. Say, for example, let's say you're walking down, you're at Mount Pearl campus. Let's say they let us back in. Okay, you find a $20 bill in the corridor. What would you do? Go ahead. Feel free to use the chat function or unmute yourself.
I'm keeping it.
You're keeping it? Okay.
Finders keepers.
Finders keepers. Okay. I like you guys. You guys will make great accountants.
I'm enjoying a nice lunch.
Okay, fair. So nobody wants to return it or, take it to lost and found? Come on.
You might donate it.
You might donate it. Okay, that's fair. Right? So there are different things that you could do with that. Now, what is wrong with that? Okay, so somebody has a very valid point that if you take it to lost and found, the security gets to keep it. Okay, and that's very valid observation, right? When it comes to cash, that is a very valid observation. So we do have a couple of things that we can do with that money. One is we keep it. The other is we take it to lost and found. The third one possibly is try to locate the owner of that money, right? But who knows who that belongs to? Now, is there anything unethical for you to keep that money? Or is there anything legally wrong?
If you saw the person drop it and you kept it, that might be a little bit in the unethical side.
That's perfect. And it really depends. And in a lot of situations, it really depends on what you're looking at. There is not a clear distinction between ethical and unethical. Now, we didn't steal the money. So legally, we were not wrong. We just found it. Right now, some might say that, we want to go with the golden rule that you should treat others how you want to be treated. Right. So it's not yours to keep. So it's unethical for you to keep that money because it doesn't belong to you, right? So it really depends on how you look at that situation. Ethics is such a gray area. Depending on how you want to interpret that information, you can come up with so many different ways of looking at it. Okay, so Reese does say that it is unethical to keep it because it's not yours to keep, right? So that is what ethics is. And the focus on ethics have come into play since Enron times. Okay, since that debacle happened, that's what brought the conversation about ethics. And now we want our accountants to be as ethical as they can be. So that brings us to BE 1-1. And so let's see. So that is what your textbook looks like, the 8th edition. All right, where is it? BE 1-1, here we are. Okay, so the following list presents different types of evaluation made by various users of accounting information. So determining if the company can pay for the purchase made on account. So what are we doing here? So we are saying what type of evaluation and what type of user this is. So situation 1, determining if the company can pay for purchases made on account. What do you think? No, nothing?
The company treasurer or the accountant?
The company treasurer or the accountant. So we have the investor, which was given to us, which is number 5, trying to determine if the company's net income may result in a share price increase. So we are left with marketing manager, creditor, CFO, Canada Revenue Agency, and labor union. So who would want to determine if the company can pay for purchases made on account? That will be your creditor.
CFO.
Well,
CFO.
CFO is more of a higher level. Okay. Now, CFOs usually are at the top of your food chain. So these guys are really not concerned with your day-to-day operations. All right. These guys are making the high-level decisions and the direction the company wants to go. They are not going to care about, who is paying and who is not paying and all of that. They have other guys or the accountants or the managers to run the day-to-day operations. Right. So the only people that would care about this in this case would be your creditor. Your creditor wants to make sure that when they are lending you money, the company does have the ability to pay it back. Think of your supplies guys. So when the companies buy supplies, okay, let's say we get office supplies. So when we purchase the office supplies, the supplies come in and then they give us 30 days to make a payment, right? So that's the risk they're taking by lending us money for 30 days. They want to make sure that the company does have the ability of paying that back when they're lending that credit. So in this case, it's the creditor. Creditor always wants to make sure that their money is protected and it will come back. Number two, determining if the company has complied with income tax regulations. Who do you think would care about that? This one is quite obvious. CRA.
Is
We
CRA.
all, perfect. We all love CRA. Are there any CRA employees? Come on. No one? I just like to cover my bases though. All right. Okay, so that will be Canada Revenue Agency. They want to make sure that the company is complying with the income tax regulation because that's their revenue stream. That's how they make money. So they want to make sure that the companies are paying correct income taxes, that the companies are remitting the payroll taxes as they're supposed to. Number three, determining if the company could afford a 1% salary increase. This one is fairly easy too.
That one would probably be labor union, right?
That will be the labor union, exactly. Okay, so when the labor unions look at the information, it's the same. So labor union, would that be internal or external? What do you think?
External.
Will be external. Perfect. So labor union is never on the payroll of the company. Okay, so that is an external user. So these guys look at the financial statements to make sure that when they're pitching that 1% increase, they want to make sure that the company does have the ability to pay that, right? They don't want to pitch if the company is losing money, right? Let's say if you're looking at financial statements in the COVID times, okay, nobody's getting any increase. We'll be lucky to have a job. So when those decisions are made, it has to be based on something. So these labor union guys are looking at financial statements when they're recommending that increase. Number four, determining if an advertising campaign was cost effective. That's your marketing manager who is external. External or internal?
Internal.
That is internal. Okay, because marketing manager is on the payroll of the business. So they want to make sure or know how successful or cost effective their marketing campaign was. And accountants are able to provide all of that information. Determining if the company's net income may result in share price increase. Now, this is a high level decision. This is where your CFO will come into play. So your CFO will be an internal party. So the CFO wants to make sure that these guys are making the high level decisions. So they are interested in the share prices. Okay, so number five is your CFO, your Chief Financial Officer. Number six, determining if the company should use debt or equity financing. What is debt or equity financing? What is financing? Raising money? Okay, so debt and equity financing is how the business can raise money. There are a couple of different ways that the business can raise money. One is they can bring money through their regular operations, right, which is their net income. Alternatively, they can borrow from the bank, which is debt financing, so they can take a loan. So the money comes in, but they also have debt. On the other hand, the company can sell their shares. That is equity financing. All right. So who do you think is going to worry about that? Whether the company should raise money using debt, which is a liability, a debt. Okay, so that means a bank loan, or sell the shares to raise the money.
The CFO.
The CFO. This is a high level decision. It's not an everyday thing that we do, right? So that decision will be made by the CFO. Does that make sense so far? Awesome. Okay, and feel free to let me know if you have any questions while we are discussing a concept. All right, we're also looking at E1-1. All right. So Facebook Inc. is a public corporation and has been one of the world's most attractive social networking sites. Its revenue is generated primarily from advertising. So we are to identify two internal users of Facebook accounting information and what type of information they might be looking at, and two external users and what type of questions they might be looking to address. What are your thoughts? Go with whichever, internal or external. Anyone on the payroll becomes an internal user. Anyone outside the business becomes an external.
There might be external marketing managers.
Okay, and what are they trying to get?
Create advertising campaigns that they can put on Facebook that Facebook then uses to make money.
Oh, so the outside manager is looking to advertise their business on Facebook? Is that what it is?
Yeah.
Oh, okay, that makes sense. Right? So the other guys that might look at Facebook, hey, now keep in mind, at this point in time, we are only looking at the financial information, but these are the public platforms, so people could be looking at this from so many different perspectives, right? Recently, there was some discussion about the privacy. There was some issue that the user's information was shared without their consent, so on and so forth. So regulatory bodies are looking at that. So those are external. Your Facebook is also a publicly traded company. Okay, so Securities Exchange Commission can look at that. They are external users. Your Canada Revenue Agency would look at that. Okay, if this is in Canadian context. Okay, so internal users would be your marketing managers or your accountants to see how your cost is, where your revenues is. Say, for example, the accountant would be an internal user. They could look at the cost of certain advertising campaigns, and they can look at the revenue. They can see which revenue streams are bringing in the most value, okay, where to focus their efforts, what to stay clear of, what's making money, what's not making money. Okay, so it entirely depends on who's looking at it and why. And that's right, Taylor. There has been quite some privacy concerns with Facebook off late. Yeah, so they have been pretty popular there. So these are the basic forms of businesses that we are looking at. So basically, on a high level, this is just three types of forms: proprietorship, partnership, and corporation. Sorry, I'm just going to come out of that because I have two screens, but if I put it in the slideshow, then I can't see your chat. So I don't want to miss anything. So proprietorship and partnership, these two forms of businesses are very, very similar. So the way it works is proprietorships and partnerships make money. That money is attributed to its owners, and the owners will then pay tax on that. So there is no separate legal form for that business. So these forms of businesses, proprietorship and partnership, is tied to the life of its owners. Should something happen to the owner, these forms of businesses are deemed null and void, right? So they are strictly riding on owner. They are attached to the owner and they are seen as a single entity. The owner and the business is seen as the single entity. There is no differentiation between proprietorship and partnership, other than the fact that proprietorship, there is one person that owns the business. Partnership, there is two or more. Other than that, they are exactly the same. Okay, they are fairly easy to set up. There are not a lot of regulatory requirements that they have to go with. The owner has complete control over the business. The life of the business is limited to the life of its owner. Should something happen to the owner, the business doesn't exist. Okay? They do bear unlimited liability. This is one of the biggest flaws with the structure of proprietorship and partnership. What that means is if the business goes down, let's say if there is a legal lawsuit, then the owners of the business will have to liquidate their personal assets to satisfy that claim. So there is no distinction between personal and business. It's all deemed as one. And as we said, the income is paid by the owner. So your partnership is exactly the same, just the number of owners move from one to two or more. On the other end of the spectrum is our corporations. Now, the biggest flaw with your proprietorship and partnership is that those guys take unlimited liability. With corporations, the liability is limited to what was invested in the business, right? So that's the biggest advantage of setting up a corporation. The life of the corporation is indefinite. It's not tied to the owner. The owners are viewed as the shareholders in corporation context. So whoever owns the shares is seen as the part owner of that corporation, right? Now, shares are easily transferable. That means the corporation is not tied to the owner. It's tied to those shares. It's very easy to raise capital for the businesses that do have has set up the form as a corporation. So when the business is set up, the business, they have to choose whether they are going to set it up as a proprietorship, partnership, or a corporation. They have to take one form over the other. Okay. So at that time, they debate and see what are my biggest challenges? What is my growth prospect? What do I want to achieve with this business? Do I want a complex structure, or do I just want to, let's say, fix those um, windshield chips, right? So you will see those guys pop up in the parking lots during the summer and spring season. So that's your proprietorship and partnership. Fairly easy setup, nothing fancy there, right? But with the corporations, there is more regulations that you have to go with. If you are over a certain limit for your revenues, you have to register for GST, then you have to collect GST, then you have to file for GST. Once you have employees, then you have to do employee taxes, CPP, EI, so on and so forth. Okay, and the income taxes, of course. So there is a little bit more regulation that is attached to the corporation, which means there is more work that's going to cost you money. Right? Now, the corporations can take two forms. One is a public corporation, the other one is a private corporation. Once a corporation is set up, the ownership in the corporation is always in forms of shares. Okay, whether it's public or private, it doesn't matter, but the ownership is always in forms of shares. The number of shares that you have for the corporation, that portion against the total number of shares tells you what your ownership percent in that business is. Now, if those shares are listed on any stock exchange in the world, then it becomes a publicly traded corporation where anyone can buy and sell those shares. So that's your publicly traded corp. Your private corporations is where these shares are not listed on any stock exchange. What that means is, generally speaking, these shares are held by a closed group of investors or family members. Okay, I work for a private corporation, and by no means the size of the business is, the status of being public or private indicates the size of the business. Okay, I work for a medium-sized private business, but it's private. The shares are not listed anywhere. It's just held by the close family members. So that's how public and private works. Are we good with that? All right, so let's go to P1-2A. All right, So we have 5 independent situations that we are looking at here, and we have to determine what form of business will be best for these situations, whether proprietorship, partnership, or a corporation. And if we do pick corporation, then we need to specify whether it should be public or private. Keep in mind the needs of these businesses, right? The public-private corporation sounds really fancy, but that also means that they are big-ticket items. There will be regulatory cost. So consider the needs of these businesses before we decide what they should do. So in the first instance, we have 3 computer science professors have formed a business selling technology that enables digital monitoring for cardiac patients outside of hospital settings. Each has contributed an equal amount of cash and knowledge to the venture. While their plans look promising, they are concerned about the legal liabilities that their business might confront. What do you think? What should be best for them? Proprietorship, partnership, or corporation? So Athena is saying partnership, partnership, one for corporation, easy to raise money.
Corporation.
Corporation, lots of partnership. Okay, so most of you guys are leaning towards partnership. There are a couple of corporations there. Okay, so for these guys, their biggest concern is their legal liability. So with the partnership and proprietorship, so there are more than one person, so it has to be either partnership or corporation. Now, the flaw with the partnership is that the liability is unlimited, and these guys don't want that. That's their major concern, which means that they should be taking the corporation form. All right. Now, with the corporation, that depends on these guys whether they want to make this a public corporation or private. If they make it public, it's easier to raise money. Even for the private corporations, they can raise money fairly easily, but much more easier for the public corporations to do that. But public corporations also give out some control. Okay, so that is up to these guys, but based on the information that's given, we can only recommend that they set up a corporation. Next one. Joseph LeBlanc, a student looking for summer work, has opened a bicycle rental shop in a small shed on Trans-Canada Trail system. What should Joseph do? Set up a corporation?
Proprietorship.
Proprietorship? No one thinks differently? That's perfect. And that makes perfect sense. Okay. In accounting, guys, always think of cost benefit. Okay, so in our world, we always say that if it doesn't make sense, it doesn't make sense. Okay, so sense as in CENTS, like the money. So if it doesn't make money, it doesn't make sense. So we want to look at the needs. So here, Joseph is not looking for huge growth. He's not looking for, he doesn't have any liability concerns. He doesn't have another partner. So the easiest thing for him to do is to set this up as a proprietorship and move on. All right. Number 3, Robert Stephen and Tom Chang each owned businesses manufacturing customized snowboards and have now decided to combine their businesses. They expect that in the coming year, they will need to raise funds to expand their operations. So there are 2 guys. So either they can take proprietorship or corporation.
Corp.
Corp again? What type of corp? So somebody said public corp. And the reason being because these guys want to raise money. So public corporations can raise money fairly easily. Perfect. Darcy Becker, Ellen Sweet, and Meg Dwyer recently received their Chartered Professional Accountants designation. Friends since childhood, they have decided to start their own accounting practice. So,
Partnership.
Sorry?
Partnership.
Partnership? Okay. So partnership works better in this case. It's simple to set up. It's easy. These guys are not looking to raise funds in near future. They are not concerned about legal liabilities. So partnership is the way they should be going. Then we have Harvey, who wants to install and then rent storage lockers in airports across the country. His idea is that customers will be able to leave their luggage at the airport if they have a long layover, so they can explore the local surroundings without being burdened with luggage. This will require the rental of space in each airport as well as hiring of employees and other operating costs. Take your pick. Sole proprietorship or corporation? So I got
Probably
one
corporation.
corporation. And why is that?
I would assume liabilities might be a big thing with people leaving luggage at an airport.
Okay, liabilities is a big thing. So we want to set up a corporation. That's good. What else? So I got private corporation. What about public corporation? Now, some things in accounting, it's very logical. Now, if you think of being at an airport, everything costs an arm and a leg, right? Okay, so having these rental storage units at the airport is going to need some substantial investment, right? So it's not stated, but it's implied. So in that case, this guy's best bet would be to go with public corporation. With private corporation is not a bad idea if you know people with deep pockets. Then it works out fine, right? But yeah, if my friends are as poor as me, then that's not going to help setting up a corporation, right? So public corporation would work best in this case.
Guru, just a question for you.
Mhm.
When you say public corporation, are you saying like this company is going to be listed on like the TSX or New York Stock Exchange, like that type of public corporation?
Yes. As soon as these shares are listed on any stock exchange in the world, then they are deemed as the public corporation.
So then do you really think like for an organization that has maybe like something like this might have maximum a few hundred employees to go through the problem of being regulated by the SEC, having so much burden, have to do auditing and everything would be beneficial rather than just going the private corp route?
Well, it really depends. Okay, so if Harvey's friends, as I was indicating, if you already have an investor base, there are a few ways for you to handle this. One is if you already have an investor who is interested in your business model and they are willing to lend you the money for a certain percent of ownership, and that's the route you're okay with, then by all means you should do that. Rather than taking it public, because you're right, there will be SEC regulations. They, depending on how you are trading, there might be those SOX regulations that you have to go with if you have trade between US, Canada, that kind of a situation. So it does become a bigger bill as soon as you go public. So that should be your last resort, not the first one. Does that make sense, Tarun?
Sure. Yeah, that makes sense.
Yeah. Alrighty. Any other questions so far, guys?
I had a question about shareholders. So if a company had like one person who had more than 50% of shares, would they have more control over the company and how it works compared to the others?
Absolutely. Because that only makes logical sense, right? So let's say, so my husband and I, we have set up a partnership, not marriage. That's not what I'm talking about. We actually have set up an actual business partnership. Okay. Now, if I hold 55% interest in that, then I would have the final deciding power to say how it's run. Even if I have 51%, it's a percent more than him. So I get to decide how it's run. So it's always about the numbers. Whoever has the bigger stake gets to have a voice. And that is the whole idea of having those shares. And we'll explore those concepts as we go through the coverage. All right, so jumping into our financial statements. So these are the 4 types of financial statements that we will be referring to on and off. So there is a statement of income, there is statement of changes in equity, and statement of financial position. The 4th one is your statement of cash flow. We will discuss this in much more detail in chapter 13, which is towards the end of your course. Okay, so As you can see here, this is how we prepare the financial statements. The statement of income is always made first, then we make our statement of changes in equity, then the statement of financial position, and finally our statement of cash flow. Now, what these statements look like. So your statement of income is your revenues minus your expenses gives you your net income or loss. Right? Now, let's say if you have a bakery shop, what would be your revenue stream?
Sales.
Sell your baked goods.
Sales of your baked goods, right? Okay. What will be the expenses that can go with this? So expense is something that you are incurring in order to support your revenue. So when you are selling these baked goods, what kind of expenses would you have incurred in order to recognize that revenue?
Time, and then your ingredients for all your baked goods, I guess.
Okay, so ingredients, your labor hours, utility, any machine cost, right? So expenses is something that you have incurred in order to support your revenue. It always have to be like that, right? Let's say the bakery shop owner has a dog. So can they go ahead and expense the dog food? And while you guys think about that, I'm just going to address Tadashi's question there. So yes, you are right. So he said, let me just scroll up here. So theoretically, if you have a public corporation, but one person buys all your shares, would that make them the owner of your company? Exactly. That's how the shares work. The problem with the shares is once you have listed them on the stock exchange, you can't control them anymore. They're out there for anyone to buy. So if someone likes your business and they want to buy all your shares, or not even all, just the majority of shares, 51 is what they need to aim for, and they have taken over your business. Okay, now think of it this way. That I can never pronounce that chocolate. Bernard Callebaut, that guy lost his business because of that share structure model. He was the one who set up the business and brought it to that level, but he lost the majority stake in the business. So he was kicked out. Yeah, I can never pronounce that, but yeah, that's the one I'm talking about. All right, so that's that. Now coming back to our dog food.
Sorry, I just
Sorry.
have one question about
Uh-huh.
that. So once you go public, is there any way to ever go back from that? Like, or once you're public, that's it, you're public, you're kind of hooped.
Well, as far as I know, Justin, I haven't seen any corporation that has gone the other way. From what I'm limited in my knowledge, it's a one-way street as far as I know. If there is anything, then that company has to be dissolved and then a new one has to be set up. Right? So what they can do is just dissolve that public corporation and then go ahead and set up a newer one where the shares are not listed. But that would be a process while keeping the business the same. The model doesn't change.
Group question for you. Just to address the first one, actually, you can take a public company private. The process is just very long. But in terms of you're saying, well, if a company has 51% shares, right? So if you're a public corporation and your board of directors, let's say 2 out of 3 of them own 49% and the one owns 51%. Technically speaking, the board still controls it. So majority shareholder still, in the end of the day, isn't the only power holder, right?
That's right. That's right. And whoever holds that, and the whole idea of the board of directors is that these guys decide how the business should be run. So as long as they have the majority, that's all we are looking for.
No, sorry.
All right.
In my question, I'm saying, what if the true minority shareholders own 49%, one person owns 51%? Now, like, say if there's a decision that's being made, most of the time, wouldn't it still be like the two people that own the minority still outvote the majority because, let's say, everyone has one voting shares, right?
Well, no, because if your two guys together own only 49%, then they are using their voting shares up to the 49%. The other guy is holding 51%. So his voting right is still going to supersede the other guys. So if there is any contention between those two, then the guy who holds 51% gets to decide, have a final say.
Oh, interesting. Okay, thank you.
Yeah, always, always. It doesn't matter how many people. It matters. What matters is who has the majority stake in the business. That's the skin in the game. So, right. Okay. So coming back to our dog food. So you guys said no, 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 no. Interesting. Some of you guys said Ingrid. Oh no, that was different. That was before. So no, no, no. That's fraud. Okay, if that's unethical. Okay, that's unethical, and you're right. It's on the borderline. It will at some point in time could be seen as fraud, especially if you go through a CRA audit. So basically, expense is something that you are incurring in order to recognize revenue. All right, it always have to match with that. So in this case, the dog food cannot be expense because it is not helping you generate revenue unless you start making dog treats. Then you can expense. All right. So it needs to have a revenue to go with. That's the idea. This is what your statement of income looks like. We look at all of our revenues and we look at all of our expenses. Let me make that bigger there. Okay, so all of our revenues and all of our expenses, revenue minus expenses gives you your income before tax. Then comes our wonderful income tax expense, and that leaves us with the net income or a loss. So if the total expenses are higher than the revenue, then you would have a resulting loss. Would you have to pay taxes if you have a loss?
Yes.
No. Think of us being employees. I guess most of you guys have some sort of a job, right? So when you guys earn money, we pay income tax. But when you don't make money, you don't have to pay income tax, right? The same idea applies. If you don't make money, how are you going to pay anything? All right. So no income, no tax. All right. So your changes in equity. So your changes in equity talks about, it does have two main sections. One is your shared capital. The other one is your retained earnings. Share capital is how much was the money contributed by the shareholders, and the shareholders are deemed as the owners of these businesses. Okay. Now, for the corporations, the classes of shares is your common shares and your preferred shares. At this point in time, that's all you got to know. The actual structure of these shares is quite different, and we will explore that when we get to the corporation and the shares chapter down the line. We'll discuss it to the nth degree at that time, but at this time, just know that there are common shares and preferred shares. The common shares, so when you guys were talking about the ownership percent, that is all tied to common shares. That doesn't have anything to do with preferred shares. Your retained earnings is your asset minus your liability. So basically, right from the first day of the operation, how much has the business retained? Something that's not distributed out to the shareholders is retained. So that's what the retained earnings is. So these are the main elements of your statement of changes in equity. Your shares at the beginning of the period, those shares you could sell more shares, you as in the corporation. The corporation could sell more shares or they can repurchase their shares. Okay, so it could go in either direction. So the retained earnings basically is your revenue minus expenses, which is your net income or loss, is going into your retained earnings. So your retained earnings from the prior period at the end of the prior period becomes beginning in this period. Then we bring in your net income or loss, whether that goes up or down. Then we adjust our dividend declared. That leaves you with the retained earnings at the end of the period. Dividend is the money paid to the shareholders. This is a common layout for your statement of changes in equity, the name of the corporation, name of the financial statement, and the time period it is representing. So we have listed, the layout with the changes in equity is a little bit fluid. It really depends on what information is presented. So in this case, we only have the common shares, retained earnings, and total equity columns. But you could have preferred shares, common shares, retained earnings, accumulated OCI. There's another element that we don't talk about in this course. So this is a very, very basic structure. So it could change depending on what information is presented. And we'll look at that when we actually have the data. Statement of financial position. So this one is also called as your balance sheet. So this covers your assets, liabilities, and equity. So this financial statement looks like a T account. Okay, so if you draw a T account, that's what it looks like. On the left-hand side, we have assets. On the right-hand side, we have our liabilities and equity. So this is what your financial statement looks like. Okay, you can put your assets, liabilities, equity one below the other, or you can put them side by side. Either way, so if you look at your total asset is $29,067 in this instance, and your total liability plus shareholders' equity is exactly the same number. This is why we call it a balance sheet. Your left-hand side and the right-hand side of that balance sheet has to be exactly in balance. It can't be tilted either way. Okay. Now, what do you think is an asset?
An asset is what you own in the business. For example, like the equipment could be assets and other things that are basically just owned by the business, or cash that you had initially from the business.
All right, that's fair. So asset is something that you own. All right. When you own something, you get to determine how that asset is used, right? How are you going to use it, whether you're going to use it, or you're going to just burn that asset. You should be able to do that should you choose to, right? And that can only happen if you own it, right? So asset is something that you own. On the other end, liability is something that you owe to others, right? You're liable to pay to somebody else. And we'll explore this financial statement in chapter 2. So once we get into that in a little bit, we'll talk a whole lot about that. Okay, so your shareholders' equity is what's left in the business after your assets and liabilities are adjusted. So if you want to know what is equity in the business, that's your total assets minus your total liabilities is what's left in the business, which is the equity. Statement of cash flow, we are going to discuss this one in chapter 13, but at this point in time, we just want you to know that there is a separate statement that talks only about the cash movement, cash coming in and cash going out. That's all this statement does. It does not talk about anything other than cash. So we look at our cash and say, how is that cash moving? What are the inflows and outflows? And then we separate them into three main types of activities: your operating activities, investing, and financing. Operating is what's coming from your day-to-day operations when the business, let's say the bakery shop, their day-to-day operation is selling those baked goods. So how much cash is coming from there, and how much cash are you spending on paying for labor cost, utilities, supplies, so on and so forth. Okay. Investing activities is when that bakery owner goes ahead and buys a piece of equipment. That's the outflow of cash. That equipment is going to help him generate revenue, but that's an investment piece. He's investing in property, plant, or equipment, machinery, tools. Okay, so that's investing. And financing is, let's say if the guy takes a bank loan, that's financing activity, right? So remember, your financing activity can be two types. Either he can take debt or he can sell shares of his business. So debt or equity financing. So again, we will explore this in chapter 13. This is what your statement of cash flow looks like, but I wouldn't worry about that just yet. Now, relationship between your financial statements. Your financial statements, just a couple of slides ago, if you recall, when we listed the four statements, we said they are always prepared your statement of income first, which is your revenue expenses. Then we make your statement of changes in equity. And then we make your statement of financial position, and finally your statement of cash flow. Now, why do we make them in the same format or fashion or sequence? That's because the information from one flows to the other one. So the net income from your statement of income will flow through your statement of changes in equity. The ending numbers from your statement of changes in equity will then flow to your statement of financial position. So the information is interlinked. It flows from one statement to the other. PE 1-5. Okay, I'm just trying to pull up my Excel here to see there. Oh, okay. So I do have that here. All right. So let's see what we are doing here.
Guru, quick question for you. Are we using Excel for this class?
Well, I use Excel. I highly recommend using Excel, but it's entirely your choice how you want to do it. So when you're doing your exams, you can either do it in Excel or Word. But as long as you just send me one document at the time of the exam, then we should be good. Okay. For those of you who want to handwrite it, by all means, you're free to do that as well. But when you combine that file, make sure that I'm not getting 7 different files for a single student. Okay. I have got almost 50 students in a class and I don't want to miss anything. So just make sure that you give me one single file.
Can we use Google Sheets, or is it just the Word format?
No, you can use Google Sheets. Google Sheets is pretty much the same as Excel. It has the same backend. So yeah, you're free to use that.
All right, thank you.
And Taylor said MRU students can get Office 365 for free. Yippee, I didn't know that, so that's good. Always something new. All right, guys, so, oh, I'm looking at the wrong one there. Okay, this. So BE 1-5. So we are using the accounting equation. Now, does anyone know what an accounting equation is? That is asset equals liability plus equity. This is your accounting equation. This is what we were talking about. So basically, this is coming from your balance sheet or your statement of financial position. Okay, so be very comfortable with the terminology. So your balance sheet or your statement of financial position, when we say that it looks like a T account and it always have to be in balance, this is what we are talking about. Okay, so I'm just going to go back here. This is what we were looking at the time. So your total assets were 29,067 and your total of liability plus shareholders equity was exactly the same number. And this should always be the case. Okay, there is no way on earth that these numbers can be out. It just does not make sense. So your accounting equation or the golden equation or the golden rule that we call is your assets, always total assets have to add up to your total of liabilities plus equity. So under instance A, we know that our total liabilities is 55,000 and we know that the equity is 120,000. And where is that coming from? It's coming from here. So the shareholders equity section of Samsung Corporation is 120,000 and their liabilities are 55,000. What should be their assets? Well, if we know that our accounting equation is assets should equal liability plus equity, then liability of 55,000 and equity of 120,000, that is exactly how much our asset should be. Under B, the liabilities of this corporation is 170,000. Their share capital is $100,000 and its retained earnings is 90,000. What is the amount of total assets? So we know what the liabilities are. So the liabilities are 170,000. And this is where you guys got to be really good with the format of your financial statements to know what goes where. That's how we can determine that. Now, if you think of your equity section is made up of two components. One is the share capital. The other one is the retained earnings. So the share capital is 100,000. Retained earnings is 90,000, which means your equity is 190,000. So $190,000 of equity plus liability of 170,000 gives us asset of 360,000. It has to be because it has to match. The total assets of this corporation are 150,000. The share capital is 50,000 and retained earnings is 25,000. What is the total liability? So asset on one side is 150,000. Your equity is broken down into share capital and retained earnings. So your equity is 75,000. What should be your liability here?
75,000.
75,000, which is just the difference in those two numbers. So how are we going to balance this equation is really what we are looking at. And finally, total assets of this company are 500,000 and its liabilities are equal to half of its assets. What is the shareholders' equity? So assets are 500,000, liabilities are half of that, makes it 250,000, which means the equity must be the other half of 250,000. Are we good so far? All right. Okay, that brings us to these examples, P1-9A and P1-7A. All right, we'll just look at those examples, but let's just get through the last couple of slides here. So generally accepted accounting principle, these are the sets of rules that we follow in Canada. Okay, now GAAP, we follow the Canadian GAAP. There is also a version called as US GAAP that they follow down in US, as the name suggests. Okay, so their GAAP is quite different than our Canadian GAAP. Right, so your generally accepted accounting principle is what GAAP is. That is the accounting standards we follow in order to prepare our financial statements. Now, under that, under those rules and practices, we have two types or two sections. We have more than two, but we are only discussing two here, which is your IFRS and ASPE. Now, when we talk about your corporations being publicly traded or private corporations, if the corporation is publicly traded, that means their stock is listed on the stock exchange, then they have to follow the set of standards called as IFRS, the International Financial Reporting Standard. The publicly traded companies do not have a choice. They have to follow IFRS. That's why this becomes a little bit more complicated and expensive. Okay, IFRS standards are a bit more complex than the other set of standards. All right, so we do have to consider that cost when we say, let's go public. All right. On the other end, if your corporation is a privately held corporation where the shares are not listed on any stock exchange, then the company has a choice whether they want to follow accounting standards for private enterprises, that is the bare minimum. But should they choose to go with IFRS, they are allowed to do that. They need to take their pick. Does that make sense? Okay, so the only guys that have choice here are the private corporations. The public corporations don't have a choice. They have to go with IFRS. when it comes to annual reports, so over and above your financial statements, the 4 financial statements that we talked about, so your financial statement set is always the same. You will always have those 4 financial statements. But over and above those financial statements, we will have certain notes disclosures or the notes to the financial statement, which is very common. Generally speaking, and it's not mandatory, but generally speaking, the private corporations will do notes to financial statements. Okay. My company, we do notes to our financial statements. Publicly traded companies, on the other end, can do notes, or they can go with the MD&As, which is management discussion and analysis. All right. MD&As is quite extensive. This document actually has 6 different subsets that they have to go through. So basically, the management will describe how they see their business. Okay. They are going to say, how did the business perform? How are they going to do in future? What are their budgets? What are their long-term plans? So on, so forth. So they analyze their business on those 6 criteria that are predetermined, and then issue this management discussion and analysis. Okay, so management discussion and analysis, MD&As as we call them, they are a supplement to the notes. They are not a replacement. It's not one or the other. Okay. Then comes your auditor's report. Auditor's report is anytime a business is audited, they have to send that auditor's report. In fact, the auditor's report is the first page of the financial statements. So whoever is looking at your financial statements, the first thing they see is the auditor's report. Then comes your financial statements in the order we discussed. Right? Now, any thoughts on auditor's reports, or which companies need to get audited?
Do auditors have to be external, or can they be internal as well?
It depends on what are you looking at. In this case, if we are talking about the financial information, then the auditors have to be a third party. Okay, the audit term is used in different contexts. People or the businesses can do their process audits where they're looking at their processes to enhance the processes, make more money by using less resources. That's an internal audit, where they actually have an internal audit team, which is employees of the business. But when it comes to financial audit, which is what we are talking about here, it has to be a third party. So somebody external to the business, like KPMG or the, one of those big 4 firms, or somebody, anyone outside, any auditing firm. So what is the main difference with the annual report on the corporation and their quarterly reports? Well, it's just that the quarterly reports talks about a quarter, and the annual report talks about the whole annual performance. In terms of the financial information, there are no differences. Okay. Usually, the annual reports comes with all of this stuff. You wouldn't see the auditor's report attached to the quarterly. Okay, so that auditor's report only comes in once a year. So for the company that reports on an annual basis, every company has to report at least once annually. So at the end of the year, let's say, I'll give you an example. So for us, our year end is December 31st. So we report from January 1st to December 31st. That's our fiscal period. So at the end, once the year wraps up, that's when we get our auditors. They come in, look at our financial information, and express their opinion about that to say whether they are satisfied with it or not. Okay. So once that audit completes, then they issue us an auditor's report, which is the first page on the financial statements. Does that work? The publicly traded companies have to get audited. It's not a choice. On the other end, the private corporations, remember, I told you that I work for a private corporations, but we do get an audit done. It's not a requirement, but we still get it done. Why would you think that? Why do we get it done? out of goodness of our heart?
I would say you want to
Yeah.
make sure that the company's finances are aligned. There isn't like embezzling going on, no money being lost.
Okay, so you want to make sure, okay, fair. So you want to make sure that there is nothing missing, all right?
Peace of mind for any investors.
Sorry, do that again.
Peace of mind for any investors.
Peace of mind for any investor. Okay, keep in mind, guys, we talked about our cost benefit. If it doesn't make sense, it doesn't make sense. So what you're saying does have valid basis. But again, just to put this in context for just my business, we are a fairly decent sized business, but we are not huge by any means. The audit bill for my business can be over a six-figure number. That's not chump change, right? When I'm talking about over $100,000 bill for audit, that is not chump change. It has to add value somewhere, right? So and I told you guys that if we are private corporations, the shares are held by the family members. Okay. And these family members, they are so engaged in the day-to-day business that they know what's going on. They know the ground reality. They know where the business is going. The only way they would spend $100,000 or over on getting an auditor's report is if they are made to do that. Okay. So because we have bank loans, those banks require us to do an audit at the end of the year. So it's forced onto us. So it's not out of the goodness of the heart. Somebody is making us spend that money, and that's why we do the audit. Does that make more sense? So no company, no privately held company would do an audit just because they want to feel comfortable. No, they will find other ways to get their comfort. Are you guys good there? All right, so if we are good there, then the question for you is, do we want to look at these examples right now, the P1-9A, or do we want to take a quick 10 minutes break, come back and then look at them and then jump into chapter 2? Or do you want to wrap up chapter 1 and then take a break? What's your preference?
Finish chapter 1.
Finish chapter 1? Alrighty. Okay. So we are looking at P1-9A. So with P1-9A, I have brought the information onto my Excel. And while I'm looking at that, just a quick word of advice there. So for any of you guys who are looking to pursue further courses in accounting, do make sure to spend some time on Excel. Excel is a great tool. It's widely used in the industry. It's almost a necessity now. Okay, so with any business for that matter. Personally, for us, I don't hire anyone without Excel experience. It just does not work. So that's how the industry thinks. So if you do get the time, do make sure to invest it. It will be time well spent. All right. So this is what we are looking at, P1-9A. So this is incomplete financial information. So we are figuring out the missing pieces here. So all I did was I just brought that information into the Excel so that we can start working on that. So name of the corporation, name of the financial statement, and the period it is representing. Now we have 3 financial statements. We are only talking about 3 right now. So your statement of income, your statement of changes in equity. If you look at the dates, the way the date is reflected is same. But if you look at statement of financial position, the date is listed in a different fashion. Any thoughts on why? And I'm just going to quickly look at the chat to see if I missed anything there. Okay, so there was a question, but it was addressed. So thank you for jumping in. Taylor, you can't speak your mind because the accountant likes to confuse us. Oh, well. Okay. So when it comes to your financial statement, your income statement and statement of changes in equity, these guys always reflect the information for a period of time. So when you're saying year ended, that means the numbers here on the financial statements are for a 12-month period, and that 12-month period ended on November 30th, 2021, which means that's their year end. Okay, so this $225,000 of service revenue is not from the first day of business. Let's say you're talking about Bay. Okay, Hudson Bay is claiming to be in existence for what, 300 years now, the last I heard. Okay, so this is not the revenue from day one. It's the revenue for the last 12 months. So this is some of the ways that we interpret the information. So there are some basic rules when it comes to accounting. Right? So with your income statement and changes in equity, you always have to represent that as of the end of a period. That end of the period really depends on um, how often you are reporting. This is for the 12-month period or the year ended. That day, it could be month ending. That means you're making 12 statements at the end of every month, or it could be a quarter ended, which means the number depict uh, the information for that particular quarter. All right. So that is with regards to your income statement and changes in equity. With regards to your statement of financial position, this guy is a little bit different. This guy is like a snapshot. So if we took a picture of the business on November 30th, 2021, this is what it looks like. But the good part is, this is cumulative right from the first day that this business came into existence. So from the first day up until November 30th, 2021 is what this cumulatively looks like. All right, so it's like a snapshot. The other two are representing only a time period. Does that make sense? All right. Okay, so let's look at the missing information then. So we know that in this case, for the 12-month period, this company has earned service revenue of $225,000. There must have been some operating expenses, something that you incur to support your revenue. We don't know how much that was, but we know that our income before income tax was 45,000. So how did it fall from 225,000 to 45,000? Is because of expenses. So 225,000 minus 45,000 gives you your operating expenses. So this is just a mathematical calculation. I haven't done anything fancy here. Okay, so I'm just calculating the missing number. So out of the total income of 45,000, if 9,000 has to be paid for income tax, then our net income is going to be the difference of $36,000. Looking at our statement of changes in equity, other than the name of the financial statement, your title is exactly the same as your statement of income. So in this case, oops, this one should be okay. So if the year is ending on November 30th, 2021, then it must have started on December the 1st, 2020, ending on November 30th, 2021. So they have given us the 250,000 raised by issuing common shares, and this was done in that 12-month period. So the total common shares is $250,000. Now, remember, we said we prepare our financial statements in the same order. So the statement of income first, then we do our statement of changes in equity, and then we do our financial statement of financial position. So this net income number that you calculated for 36,000 will be brought to your statement of changes in equity. And that is why we make them in the same sequence. So our net income of 36,000 minus the dividend that you're paying. So the income is going to increase your equity in the business, and dividend is the money that the business is paying to the shareholders. So that is going to reduce your equity. So your beginning retained earnings was a zero. We earned income of $36,000 and we paid $15,000 in dividend, which means our remaining retained earnings in the business at the end of November 30th, 2021 is $21,000. Your equity item is just an addition. Okay, so we have just thrown an addition formula for those rows. Nothing fancy. Now, once you have prepared your statement of changes in equity, then that information will flow through your statement of financial position. So we know that our total common shares is worth $250,000. Our retained earnings is $21,000, and our total equity, which is common shares plus retained earnings, is $271,000. Okay, so this is your statement of financial position. So this is what the T account layout is. Your total of assets on the left-hand side has to equal your total of liabilities and shareholders' equity. No way they should be out. So a bunch of information is provided to us, but the others are missing. So any thoughts on where you would like to start?
So you know,
Knowing what, sorry, go ahead.
yeah, so you know that the total liabilities and shareholders' equity is $964,000. So if the right side has to equal the left side, you know that total assets should also equal 964.
This should be 964. Awesome. Okay, and that is how you connect dots. If we said that our accounting equation is assets has to equal total liabilities and shareholders' equity, we didn't know what the totals were, but we knew that the total liability and shareholder equity added up to 964,000. So your total of asset should add to 964. Now, out of the $964,000 of asset, we know how much is your cash, your accounts receivable, building and equipment, which means the difference in those numbers must be our land. So all I've done is I've just calculated 964,000 minus the cash, AR, building, and equipment. So that gives you the worth of your land. So moving on to the right-hand side, any thoughts here? Do we want to calculate the accounts payable first or the shareholder equity first? You can go with either or. You have enough information.
For the accounts payable, you would most likely take the total liabilities and subtract it from the bank loan payable.
Perfect. And it has to make mathematical sense. So if our accounts payable liability was 93,000 and our bank loan payable is 600,000, then it makes perfect sense that our total liability is 693,000. What about the shareholder equity section? How do we get that? Because we are missing the common shares, we are missing the retained earnings, and we have no idea what total shareholder equity is. So few different ways to look at it. Your total shareholders equity. Okay, so we said your total liability and shareholder equity is 964,000. Out of that number, you know what your total liability is. That means the shareholder equity must be the difference in those two, right? So 693,000 plus 271,000 should give you 964, right? The common shares and the retained earnings, remember the flow of your information. The information is flowing from one statement to the other. So if I scroll up here, you said your common shares were $250,000 and your retained earnings is 21,000. So let's bring that information forward. It's already calculated, and that is how the information flows. That's why we make these financials in the same order. Okay, let's move on to P1-7A. Okay, so P1-7A. So on June the 1st, 2021, One Planet Cosmetic Corporation was formed. Its assets, liabilities, share capital, revenue, expenses, and dividends as at June the 30th are stated. So we have a bunch of accounts and the balances in those accounts. So we are preparing statement of income, statement of changes in equity, statement of financial position, and then we will explain why they are made in the same order. So a couple of different ways you guys can do this. What I like to do is I like to work with some sort of a structure. Okay, so I always make some sort of a skeleton and then come back and complete my financial statements, but that's how I like to do it. It's just a suggestion. So the title to the financial statement. So the name of the business, One Planet Cosmetic Corp, name of the financial statement, and the period it is depicting. In this case, it is for a month ended June 30th, 2021, which means all revenue, expenses, income or loss is for that 1 month period. We know that statement of income generally has revenue, it has expenses. So revenue minus expenses gives you your income before taxes. Then we slap on our income tax expense, and the resulting difference is our net profit or loss. When it comes to statement of changes in equity, we are going to keep it simple. So our common shares, so CS is your common shares, RE is your retained earnings, and a column for total equity. Beginning balances for all of these accounts, any issuance of common shares, your profit and loss, which is coming from your income statement here, and any adjustment for dividends. And then for your statement of financial position, the only thing that's changing in the title is the date. So this is as of June 30th, 2001. On the left-hand side, we have our assets. On the right-hand side, we have our liabilities and equity section, right? So if all goes well, then our total of asset has to equal our total of liabilities and equity. Once you have some sort of a structure ready, then we can look at the accounts and see where those accounts should go. So where should the cash account go? What financial statement? Statement of income, retained earnings, or the statement of financial position?
Statement of income.
Statement of income. Statement of income only captures revenues and expenses. Cash is an asset. This is something that you have that is available for you to spend. Okay, so cash is an asset. It will go, you know what, hang in 1 second. I'm debating if I should actually take you to chapter 2 so that we understand this a little bit better.
Wait, cash, isn't it like share capital? No?
No, cash is an asset. Cash is what
Okay.
you. Okay, so you know what, guys? Let's park this one. Let's take that break here. We'll come back to this example because with chapter 2, I will run you through the details of each element that goes into this financial statement. And probably that would make more sense. Does that work? Is that okay with you guys?
Yep.
All right.
Yep.
So let's take that quick 10 minutes break. It is about 7:41. So be back about 7:51-ish. And then we can start with chapter 2 and then come back to this example. All right. I'm just going to go grab a glass of water, but let me know if you guys have any questions and you want me to stick around here. I'm just going to stop the recording. I can't pause it, so I'll have to stop this guy. So does anyone have